We're with advisor, friend, and blogger extraordinaire, Michael Kitces. Michael, you recently aroused some controversy with your idea or contention that perhaps for investment planning, retirees should increase their equity allocations as they get older, which seems to go against, 700 years of investment theory.
Well, it's a funny thing. So it does and doesn't. And I look at this the way that we actually arrived at as we were working on some of the research. So imagine I have a portfolio. I'm running kind of one of these classic bucket strategies. So I'll start with like a really simple version. I'm going to put 10 years worth of your spending in bonds. We'll ladder them out so we know exactly where your spending is going to come from the next 10 years in bonds. And everything else is going to be in equities, which now by definition we don't need to touch for the next 10 years. We ask the client, are you comfortable with this as an investment strategy? Okay. Yeah, like I won't have to touch stocks for 10 years. This makes me a little more comfortable to own them. So then we start doing the spending. We start spending down some of the bonds. They're comfortable. We don't have to touch the stocks. They're still sitting out there. We can spend down some of the bonds. If you look at what you're actually doing at that point, you're letting equities grow. You're spending down bonds. You are increasing your equity exposure on your net worth statement year by year. Now, we don't think of it that way, but that's exactly what's going on. In fact, we do the same thing with annuities. So if I take part of my portfolio and I partially annuitize, and then I invest the rest in and keep it in a portfolio with stocks. As years go by, the value of the annuity comes down, the portfolio is growing, you have now engineered a rising equity glide path. In fact, everybody actually does it already just with Social Security. The value of your Social Security declines as you get older, your portfolio is growing, you are actually creating a rising equity glide path. So we do it already, we just never thought about it that way. Our focus of the research was to really show this is what we're actually doing, and it's actually okay, it works. And it works well enough that even if you don't have, say, an annuitized stream of income, you can run your portfolio in the same manner, do these kinds of liquidation strategies that wind down bonds and let stocks grow, and get to the same point, and it's okay. It's actually helpful. It's a positive.
What about the timing issue? But sometime during the course of this, there may be a market correction, and then the equities decline in value. Then what happens?
Yeah. Well, so here's kind of the basis of what we found. If you were going to own a 60-40 client for your client, 60-40 portfolio for your client, anyways, own half of that, owns 30, and then glide back to 60 over the next 30 years. So what happens if I'm doing this and my client goes through a 2008? Instead of owning 60% in equities, they'll own 30% in equities. This is much, much easier to handle. You will lose less money. And what will you do at the end of the year? You'll rebalance them the same way that we already do. And instead of rebalancing them to 30% in equities, you'll rebalance them to 31% in equities, which virtually none of them will probably even notice. So all you've actually done at the end of the day is they owned half as much in stocks, they lost less in a bear market, and you did the same rebalancing you do all along.
Seems like it makes a lot of sense. How's this been going over, your reaction you've received since you published the paper?
It's been an interesting kind of reaction since we published the paper. So we've seen a few people that were already implementing bucket strategies that basically said, yeah, we've been doing this live with clients for 20 years. It works great, but thanks for validating it. Then we've seen other people who maybe didn't think in terms of buckets in the first place and really look at a total return basis who are kind of going, oh, all right, I guess I sort of see that, but I need to think about it a little bit more. But to me, the fundamental takeaway of it is just we're owning less in equities basically throughout retirement. You're still never going to glide them above whatever their risk tolerance was in the first place. It's just a strategy where clients own less risky assets throughout their retirement and get better outcomes. So that seems pretty appealing to me.
That sounds good. And what about the response of people who think that's a crackpot idea? Any of those kinds of comments?
None that have really been that extreme. Again, because we're talking about modest shifts. We're talking about things like if you were going to own 60 in equities, own 30 and glide back to 61% a year. It's not like we're saying, hey, grandma should own 90% in stocks when she's 90 years old. I think anybody's going to realize that's probably a problem in today's world. So we haven't had too many kind of extreme responses to it. I think there's just been a lot of kind of thinking and pondering about it so far.